This is a continuation of the previous scenario case study, where Mr. and Mrs. X have a portfolio, assets and liability as such. What they want to achieve is listed here, and what they want to know, their burning questions, are listed here. Now let me show you a snapshot of preview of how we do a fee-based financial planning. Now essentially, this is how a summary of how fee-based financial planning can tell you. It might look a lot of figures, and it might overwhelm you, but I'm just going to give you a preview of how this whole framework actually helps you to plan for your retirement if you're heading to one, and if you're already retired, help you to visualize how long your assets will last, until what age, and considering how it impacts your financial goals and the others around you. So I'm going to go through this pretty quick. I don't want to really overwhelm you with too much of the figures and whatnot, because if you engage a fee-based financial planning, we are going to, as a client and advisor, we are going to spend a lot of time actually going through how one things affect another, and how this whole change one variable or change a few variables, and how the whole thing actually can affect your entire financial roadmap. So this is how it goes. Normally, on a financial road mapping or scenario modeling, you have something like, this is your current year, what's the year, and this is your age, and we will also put in, so it's very easy to visualize, your children's age. And of course, we want to say that what are the assets meaning that your liquid assets normally, or any assets in liquid form that can fund your future financial goals. And then you have what we call as your annual expenses. Annual expenses meaning is, it refers to your expenses, day-to-day expenses, expenditure. This is all figures are in annual. And of course, this is what you call asset after withdrawal, which essentially meaning that what you have, and then what you need to spend on that particular year, you should have allocated that at the beginning of the year. That is why this is an amount that was what was deducted, the annual expenses need, against your opening asset balance. And of course, this is to help you visualize how a financial gain or loss, asset gain or loss, it could be something that asset that you dispense off, something that is unexpected, like a stock market downturn or whatnot, you need to buy a car. So this is where it will actually deplete your liquid asset. And the next moving forward is what we call as a asset being expense. Again, this is to segregate what are the asset that is being expensed out of your annual income. And essentially, after deducting these two, asset gain or loss and asset expense, you have your asset balance. What will be your projected average return rate? Take a very conservative figure, and thereafter we will have your what we call the absolute return sum, which is a percentage out of your asset balance over here. And then you will have your return sum reinvested. Why this column exists is that it's very likely for most people, their profit from the investment, not 100% are being reinvested. Some they will use it for global vacation and whatnot. So that's why it's accounted for. And this is what we call additional asset. It could be a bonus, something you did not expect, a downfall, not downfall, meaning that what we call in Malay term is a durian runtuh, something that is a windfall, right? Something a windfall, or you have to liquidate some of your properties which is not included in this asset balance, and this will add on to your total balance, which actually before it gets carried over to the following year, it will have your annual income expectation as well. And this annual income in this scenario analysis, why you see there's a lot of colors over here, is actually a legend to say that this what does this represent. This actually represent the time where he sold this kind of money. You expect to sell these a few properties so that he can fund in 2019 he can fund a very expensive property purchase for his own stay, which needs about 500,000. And because of that, he needs to prepare to liquidate some of the existing asset or properties in order to fund this. And you can see this whole roadmap how it comes to, and you can see this income actually stops at the age of 55, because that is what he wants. He wants to stop working. But at the same time, this is what are these asset, this obligation. This is what we call as a children education fund for the first children, and this is for the second children. You see, this is, so it was at the time when the first child reached 19, you have to go to uni 4 years. This would be the expected expenses. And you can see that why here it have a red over here is because this scenario shows that he works until 55. Yes, he works until 55, he no more generating income, but at the same time he needs to still pay for his condominium purchase that was here until he is actually 65 years old. Okay, 65 years old, and at the same time you need to fund for this children education when he's no longer generating income. And this is how just a very snapshot, it tells you these columns are in red, because if he were to continue doing what he's doing with this income and stop working at 55, he's going to face a shortfall, right, at age 63, which is why it's represented by the red over here. And of course, bear in mind that along the way you have things like the spouse EPF, or what we call as a pension fund or retirement fund, the public retirement fund that can be used to fund everything. But again, it would not be enough, because I can project that by what age you're going to run out of money if you stop working at 55, compared to if you were to stay in that job with all those increment, expected increment and whatnot. If you were to stay in that position, and if you extend your working life until 60, now things improve, you see, things improve. But at the same time, you have to notice that this money or retirement nest egg, if nothing changed in terms of funding children education and whatnot, still paying for the new condo purchase here when he was he's 47 years old, you can see that it extend the roadmap, and he will only run out of money at age 70. So ideally, it seems that if nothing change, I mean, if he insists on buying that property at the age of 47, insists on sending his children education expense like this, you will run out of money at the age of 70. Compared to if you work until age 65, you can see that there's a lot of difference over here. The fact that the scenario becomes much better. There's no cells highlighted by red. That means there's no shortfall even he were to live until the age 80. So this is the powerful thing about scenario analysis modeling or financial road mapping in a true sense of fee-based financial planning.